Welcome to the deep dive. Today, we're going to do something a little different. We're aiming for a crystal clear financial snapshot of a company's Q2 fiscal 2026.
But with a very specific filter.
Exactly. We're looking at this exclusively through the lens of the CFO's opening remarks from the earnings call.
Right. So not the CEO's vision, not the Q&A. This is just the ground truth. This is the mechanics of, how the money moved and what the hard numbers are telling them.
It's the strategy, right? Spending, saving, forecasting. We want to see where they grew, where the pressure points were, and what compromises they had to make.
I think that's the key word, compromises.
Okay, so let's jump right in. The headline performance for Q2, what was the top line number?
The top line number, it actually showed some growth. Total net sales hit $160.5 million.
And that's up from last year.
It is. It's a 2.5% increase year over year. And, in this kind of retail environment, the CFO basically framed any growth as them taking market share.
Gaining share is huge. But where did that 2.5% actually come from? Was it all online or was it brick and mortar?
Well, this is where the story gets really interesting. It was overwhelmingly physical retail.
The showrooms.
The showrooms were absolutely the growth engine. Their net sales jumped by 10.4% to $109.1 million.
Wow. Okay, 10.4%. Is that just existing showrooms selling more?
Not really. That's the thing. Comparable sales were only up about 0.9%. The real driver was network expansion. They added a net of 16 new showrooms.
So they're literally building their way to growth.
That's a good way to put it.
Okay, so if showrooms are doing all the work, what's happening on the digital side?
That's the complete opposite story, and maybe a point of concern. Internet sales actually went down.
Down by how much?
They decreased by 4.1%, landing at $42.5 million.
So it suggests that for big-ticket items like this, maybe people still want to see them in person.
It could be that, or just that discretionary spending online is drying up faster. It's a tough read.
And there was that third, smaller bucket, other sales. That one fell off a cliff.
It did. A massive drop, down 33.6% to just $9.0 million.
Why so bad? What's in that category?
Well, it's things like pop-ups, open box sales. But the CFO called out one thing specifically.
Which was?
The decision to not do any barter transactions this quarter.
Wait, okay, that's a strategic choice. They're walking away from revenue there. Why would they do that?
I think it points to a focus on quality of revenue, Barter can be messy. It complicates the books.
So this is about discipline. They want cleaner, higher margin sales, even if it hurts that one little slice of the revenue pie.
Exactly. Clean up the books, focus on the core.
That brings us perfectly to the product mix, because there was a big split there too, right? Between the main product lines.
A huge split. Sectional sales, their flagship product, they were up a healthy 4.6%.
Okay, that's solid.
But Sac sales, they decreased sharply by 22.5%.
22%, that's a massive drop. What does that tell you?
It tells me consumers are getting cautious. A sectional is a piece of furniture you need. You're replacing an old couch. A Sac is fun. It's a discretionary purchase.
And that's the first thing to get cut from the budget when things are tight.
Absolutely. The smaller items, like pillows and accessories, were up a tiny bit, like 2%. But the story is really sectionals holding strong while Sacs are weak.
So a really mixed revenue picture. Strong showrooms, weak internet, strong sectionals, weak Sacs. But they got growth. What did that growth cost them? Let's talk about the bottom line.
And this is where the story takes a turn. The pressure point for the entire quarter was gross margin.
It got squeezed.
It didn't just get squeezed, it contracted significantly. We're talking a decline of 260 basis points.
Okay, let's break that down for everyone. 260 basis points, that's 2.6%. Their margin fell from 59% last year all the way down to 56.4%. That's a serious hit.
It's a huge hit. And the CFO laid out the three reasons very clearly.
What were they?
It was a perfect storm, really. First, 110 basis points of that came from higher inbound transportation costs.
So getting products from the factory to the warehouse?
Exactly. Then another 50 basis points came from higher outbound costs.
Getting the product from their warehouse to the customer.
Right. So right there, that's 160 basis points, 1.6% of margin just gone. Eaten up by logistics.
They were getting hit coming and going. What was the last piece?
The other 100 basis points was all about promotional discounting.
So they had to cut prices to keep people buying.
They had to. To get that market share growth we talked about, they had to be more aggressive on promotions. So they basically paid for that growth with their margin.
That is a tough, tough environment. Okay, so their variable costs went way up. Did they manage to control their overhead, their SG&A?
They did. And this is the operational win in the quarter. They showed incredible discipline. SG&A as a percent of sales actually decreased.
It did. By how much?
It fell to 44.9% from 47.0% last year. That's 210 basis points of leverage.
Yeah.
A really impressive job of managing controllable costs.
How'd they even do that while opening 16 new showrooms? That sounds expensive.
They cut back on things like professional fees, credit card fees.
Yeah.
Just tighter management across the board. And what's really amazing is they did this despite taking a $1.9 million one-time hit.
Oh, right, from the Best Buy partnership ending.
Exactly. So they absorbed that hit and still improved their expense ratio. It shows they were actively managing what they could to offset what they couldn't.
So let's get the final numbers. When you put it all together, the margin pressure versus the SG&A control, where did profitability land?
The margin pressure won the fight in Q2. The operating loss was $8.8 million, which is a little worse than the $8.4 million loss last year.
And adjusted EBITDA.
That's where you really see the hit. It dropped from $1.5 million in profit last year to just $0.8 million this quarter.
Wow. So their profit engine was cut almost in half, even on an adjusted basis. That just shows how brutal that margin crunch was. Okay, let's pivot to the balance sheet. If profits are getting squeezed, the foundation needs to be solid. What's their cash situation like?
Their liquidity is a major strength. They ended the quarter with $34.2 million in cash.
And debt.
No borrowings. And they still have $36 million available on their credit facility if they need it, so they have a solid war chest.
Which they'll need, especially with the launch of the new Snug platform. That kind of launch eats up cash. What's the inventory plan?
This part is really smart, I think. The CFO described a very intentional trade-off.
A trade-off?
Yeah. The plan is to actively reduce their excess core inventory, so maybe some older sectional models, and convert that into working capital.
And then use that cash
to build up the initial stock for the new Snug product line.
Yeah.
They're essentially self-funding the launch by liquidating older stuff.
So they're swapping old inventory for new. What's the long-term goal for inventory levels?
The goal is to end the full fiscal year, FY26, with lower total inventory dollars than they have right now, and also lower than the end of last year.
That's a really disciplined move. They're clearing the decks.
Exactly, making a bet that the future sales from Snug are going to be way more valuable.
Okay, so that sets the stage for the second half of the year. Let's turn to the outlook. What are the big assumptions driving their forecast?
The main assumption is pretty cautious. They're sticking to their plan for a 5% full-year decline in the overall furniture category.
So even if they saw things get a little better in July?
They're not counting on it. They're planning to grow by taking share, not by having the market lift them up.
And those pressures we talked about, tariffs, discounting, are those expected to continue?
Yes, and the CFO is very direct about this. He said the gross margin pressure will be at its worst in Q3.
Q3 is the bottom.
Q3 is the valley of pain. It's a combination of a worsening tariff situation and just the continued need for competitive discounting.
So let's see the numbers. What's the updated guidance for the full year, FY26?
For the full year, they tightened the range for net sales a bit to between $710 and $740 million. That's still 4% and 9% growth.
And profit.
Adjusted EBITDA is guided for $42 to $55 million, and they expect gross margins for the full year to recover to between 57% and 58%.
Which implies a huge comeback in Q4 after a terrible Q3.
A huge comeback.
So what does that Q3 guidance look like, specifically?
It's tough. Net sales between $151 and $161 million. But here's the headline. They are forecasting an adjusted EBITDA loss for Q3.
A loss? How big?
Somewhere between a $1 million and a $7 million loss. This is the quarter where everything hits at once. Margins will be at their lowest, between 56% and 57%.
So that's the cost of holding on to market share and eating those tariff hits? But are they confident they can actually pull off that Q4 recovery?
They seem to be. The CFO mentioned they've identified specific measures, things like logistics improvements and changing their promotional strategy, that should start benefiting margins in Q4. They have a plan.
This deep dive really shows a company that is just fighting tooth and nail to grow when the whole market is shrinking.
Mm-hmm.
You can see the success in the showroom numbers and the cost control.
Right, but you can also see the price they're paying for it.
In every single basis point of that gross margin, the transport costs, the discounting, it paints a very clear picture of the headwinds.
Absolutely. And the key takeaway for you, the listener, is just watching this balancing act. They are managing the controllables almost perfectly while investing heavily in growth like Snug and new stores.
And they're willing to take a big, painful hit in Q3 to make it happen.
They are. They're playing the long game, betting that this short-term pain is what's necessary for long-term market dominance.
So what's the provocative thought we should leave everyone with? What's the question to chew on?
Well, given the CFO's whole strategy of prudence and investment,
Yeah.
how quickly does that new snug product have to start flying off the shelves?
You mean to make sure the Q4 recovery actually happens?
Exactly. They're liquidating old inventory to fund this new line. That's a high-stakes bet. Is their forecast for the end of the year based just on getting costs under control, or does it rely entirely on this brand new product being an immediate massive hit with consumers?
A high-stakes internal financing mechanism.
That's what it is. And its success depends completely on immediate consumer demand.